Welcome to Deal Dialogue.
Hello and welcome to Deal Dialogue, a discussion on all things related to M&A and financing. I am Rob Hickey with RBC Mid-Market M&A, and I'm really excited about our topic and our guest. We're going to focus on one portion of the capital spectrum today, venture capital. Joining us from Framework Ventures, along with our production engineer, Tarek Chami, is Peter Mizik, who is founder and partner with Framework. Peter, welcome.
Thanks for having me, Rob.
Great. Today's topic is one that I know will be of interest, particularly to those focused on the technology space. Before we get into the detail, Peter, it would be great if we can understand the lens that you're looking through. Can you give us a quick overview of your background and how you got here?
Sure. So been a part-time venture capitalist for about 15 years and full-time for 5, roughly 20 deals over 20 years, annualized just over 45-50%. A couple of unicorns, a couple of zeros. Overall, it's been a great ride.
And in terms of your own professional background?
So spent 15 years, Bay Street, City of London, Wall Street. My last gig was in New York, co-heading tech research with Jefferies.
So you were a tech analyst.
I was.
What kind of companies did you cover?
So I covered Apple, Amazon Web Services. Those would be the two biggest and best name knowns.
Okay. Let's get into our topic. So venture capital, what is it and how does it differ from, say, traditional private equity?
Well, on one lens, venture capital is viewed as nothing more than money at a growth stage. So companies are typically doing 2 to 5 million of revenue and want to grow faster, so they take money from folks like me. However, we view venture capital as far more activist and far more operational. So we get involved in everything from talent to technology to sales and marketing to help our companies grow.
What is a VC's investment horizon?
We're typically 7 to 10 years as our investment horizon. Over 20 years, my average hold period is roughly 6.5 years.
How big are the companies when you invest in them in terms of revenue? Are they startups? Are they
They're typically doing 2 to 10 million of revenue, growing at 100% plus year over year. And when we exit, if it's a good exit, they're typically approaching 100 million plus in revenue.
In venture capital, what kind of targeted returns do you look at?
Our internal targets are 50%.
Wow. How are venture capital investments typically structured in the cap table?
So we take preferred shares and we take priority over all other equity. In terms of the debt stack, we don't touch anything to do with debt. Typically, our companies bring in venture debt or senior subordinated debt at some point when we work with them, just to try and extend the runway and allow us to push out the next capital horizon, our next capital raising.
Do you typically invest alone or in a club?
We almost always invest in as a club. So all of our LPs are given co-investment rights, and we look at bringing in strategics. Just to give a couple of examples, in our last 2 deals, we brought in a very large global strategic, which was potentially a competitor to one of our companies. And then in our other deal, we brought in a potential customer as a co-investor.
Wow. What stage do you typically invest at?
Series A, Series B.
Okay. When you look at the funds themselves that you're managing, who are your investors at a broad level?
At a broad level, they're strategics, banks, including RBC, and at another level, they're institutional money managers.
How do you convince your investors to invest with you?
So we really offer 3 things to our investors. The first is great returns. The second is an unbelievable lens on the marketplace. So we see 300 to 400 companies a month. We have an outbound calling team and data team. So they send, to rewind and send, they send roughly 1,000 emails a month. We have a 40 to 50% hit rate. They then chat and call 300 to 400 companies a month. We collect 50 to 60 data fields, score all of those companies. And the top ones each month, usually around 3 or 4, we do a little bit more work on. We then stack rank those over a 3-month time frame and usually invest in 1 a quarter as sort of our pacing. So we now track 9,000 companies across Canada and the center of the United States. Those are the markets we target. We avoid the Valley and we avoid the Northeast of the United States.
Well, that gives me some perspective on why investors might be attracted to Framework. What is it that you feel sets you apart from the perspective of a potential investee company?
So that data we then turn to the benefit of our portfolio company. So we know in year 3 of a fintech company doing lending, that customer acquisition costs will go to X percent for the top percentile performing company. And we know that these 10 experiments have been tried by these companies, and we know what the lifetime value is. And so we use these milestones and data points to empower our companies, and then we approach it operationally. So we have a full-time data team that provides that data to our companies, full-time talent person. She does EQ, IQ testing with the whole management team, provides it to the company so they understand what they're dealing with on their team, helps reorg the org structure, fill in gaps, and then we bring them coaching and mentorship. The second thing we do is we put them through our atomic growth framework. It's why we called the fund framework. What that is effectively, I call it McKinsey in a can. We take their business, deconstruct it to the smallest atomic unit, and then we help build a 3 to 5 year plan. We bring sales and marketing specialists in. We bring in a full code review, tech review, line by line review, and we actually look at every line of code and say, is it open source? Is it stolen? Is it in a language that won't scale? And we provide that to our portfolio companies. So it's a 360-degree review of the business, and then it's ongoing support after that.
That sounds like a significant amount of value add for both your investors and for the companies that you're investing in.
We think it is, and we've had some really, really good feedback from global institutional investors. We've attracted capital from some of the largest fund-of-funds teams in the world, and we look forward to continuing to work with them.
If we step back for a second, why did you, just given the career path you were on in terms of Bay Street, Fleet Street, Wall Street, Silicon Valley, why did you found Framework?
So there was a gap in the market. I had the benefit of joining a fund in 1999 as a venture partner in London called DN Capital. Now they manage over €1 billion, located in London, Berlin, and Menlo Park. And they had a process that was incredibly powerful for the portfolio companies. And they had a hit rate that was unheard of in the industry. So they're a top percentile performing fund. Their Fund 3 is returning over 100% net per year to investors. Over 7 years, they've returned over 7x, and the fund's not even done yet. And so I wanted to bring that expertise to Canada. So I was sitting in New York, and Wall Street was not what it once was. The regulators would come and visit with me every quarter and ask me, well, you're a venture partner of this fund. You have this view. Do you have access to material non-public information? And these interviews got longer and more stringent, and them listening to calls, looking at emails, and I'm like, this is not fun. This is not fun at all. And what I found was the most fun was working with early stage companies and helping them grow, and providing that lens of having seen thousands of companies over 15 plus years. And in Canada, you looked at the landscape and there were literally a handful of venture capitalists, and yet there's 10,000 software companies in Canada, and they typically have to go to the Valley to get this kind of expertise. So we founded Framework to bring that expertise, that Silicon Valley-based global expertise to Canada. We just happen to be based here in Toronto.
You're listening to Deal Dialogue.
You talked a little bit before about your proactive outbound reach program. What are the other ways that you find opportunities? I've heard it said that a lot of VCs won't look at something unless it's qualified. I mean, obviously you do your own qualifications, but what are some of the other ways that you get introduced to investment opportunities?
So we believe in having an extensive ground game. So we also hold office hours at DMZ, Mars, Communitech.
Sorry, what's DMZ?
It's a Ryerson accelerator.
Okay.
We also host Toronto's largest FinTech and AI conference. Roughly 550 attendees last year. Over 500 companies applied globally. We had speakers from all the biggest internet companies around the world, the biggest banks. It really brings the ecosystem together. We do selective media, and we target companies that that pop up in our database. I mean, having 400 or 500 companies a month to go through, we can be selective. We can be thematic. We can be strategic in how we approach these companies.
Where are you focused? What are the big themes that you're looking for?
So we want B2B software companies, software-enabled marketplaces, or B2B to C or SMB software companies where they have data that's relevant to financial products or services. So think lending, think payments, think money movement. Or they have enormous data sets that are structured or could be structured to productize into AI. So for us, by doing those two things, we can take an amazing, unbelievable company and we can make it world class by either doubling, tripling, or in some cases 5xing their average revenue per user.
Very interesting. A lot has changed in the last 5 years, 10 years, 15 years. As you look over the 15 years that you've been in the venture capital business, what are the big changes that you've seen?
Mega funds, operational discipline, and I think sometimes the glamorization of the startup world. And I think in some cases, the glamorization in particular, which I'll touch on, has actually hurt us. We've gone through these ups and downs where startup creation has exploded and then collapsed. Here in Canada, we're actually experiencing a collapse right now. Startup creation is down somewhere around 40 or 50% from its peak in 2014, 2015. And that's a big problem for the economy. It's a big problem for us longer term if we don't see new startups. And we think it has to do with this fundamental belief that if you have a PowerPoint, you're going to get funded, which is completely untrue. From PowerPoint to Series B, which is one measure of success, the number of companies that succeed is less than 0.5%.
Given that perspective, what is your outlook over the next 2 to 3 years?
Extremely bullish. While we think the economies of North America have slowed and could potentially, or maybe even potentially in a recession, we think structurally, secularly, technology is just going to get more and more. So I always ask people this fundamental question. Do you think the industry you're in will have more or less technology in 10 years? And invariably the answer is more. And so if it's more, think about how do we improve the experience for the end customer? So if you're in the automotive industry, the end customer is an automobile buyer, a driver. How do we make that experience for the driver phenomenal? How do we remove all the friction that they have in their lives, whether it's service, whether it's payments, whatever it is, remove that friction and remove it at a point that we better the lives of the ultimate customer. That purpose drives us, and that purpose is what we look for in our entrepreneurs.
This has been very insightful. I have one last question for you. You touched a little bit before on what companies need to do to get funded. What advice would you give not only to companies, but to advisors, bankers, and lawyers who have clients that could be seeking capital from a firm like yours?
The number one thing we look for is that the solution that these people provide solves a major pain point, major friction for their ultimate customer. And if you do this test, the chances of you getting venture capital, I think, will be very, very high. And that test is simple. If you have a product that somebody uses every day or regularly, and you take that product away, if their lives are miserable, if they feel real physical pain, you've got something. You've got something spectacular. That's what we look for. We look for that you're fundamentally altering the lives of your end customer and you're driving this enormous value. Put the customer first and you will win. Put the customer first, you will get capital. Put the customer first and you will be successful.
Well, that's a business model that I think a lot of companies could follow. I know it's one of the key strategies and principles of our bank. So that's great to hear. That's it for this segment. We hope you found the information on venture capital useful. Peter, thank you for being with us here today.
My pleasure.
I'm Rob Hickey, and from myself and Tarek, so long and good luck with your deals. Deal Dialogue is created and produced by RBC Mid-Market M&A.